Good morning, everyone. Welcome to Tokenize Everything. Today we have a few esteemed panelists, and I'm going to be listening very intently because there's going to be a lot of alpha shared on stage. The topic is real-world assets and new emerging opportunities. While I'd like to start, maybe we can start by introducing each speaker.
Thank you, Kanny. Hi, everyone. My name is Rania, and I head up sales and business development for Ondo Finance here in Asia. Ondo Finance, we're actually here to build the assets, platforms, and infrastructure to bring financial markets on chain. Tinan mentioned in his opening speech that the future of finance will be on chain, and this year is all about building. We're doing exactly that in Ondo. For those who don't know, we're actually the first and one of the largest issuers of tokenized U.S. Treasury bills. We passed $1 billion in TVL, and it's only second to that of BlackRock's BUIDL. We see ourselves very much as the distribution partners for a lot of traditional asset managers to help them distribute their products to the hands of the crypto natives. Essentially what the stable coins did for the US dollars, Ondo Finance is here to do that for capital markets.
Cool, and good morning, everyone. My name's Alex Taylor. I'm a co-founder at CarbonMark. CarbonMark is a specialist in carbon credits. So we tokenize, facilitate the trade and the distribution of carbon credits into the market. Launched in 2023, and we were a spin out of a separate project called KlimaDAO, which was a more DeFi play on carbon credits, launched in 2021, tokenized about 25 million carbon credits and experimented with some interesting new technologies for the market. And I also serve as a council member at the Klima Foundation. So great to be here, and thanks for having me.
Great. Good morning, everyone. My name is Nikhil Joshi. I'm the COO of EMURGO. We're one of the co-hosts of On-Chain. Real pleasure to be here and to see all of you looking so fresh-faced this morning. EMURGO is a co-founding entity of Cardano. So our roots are there, but effectively we're a Web3 finance technology company, meaning we are chain agnostic, and we're a technology provider to make all things finance better, snappier, more efficient, more funky. We have a very strong interest in real-world asset tokenization, which we recognize is still somewhat of a narrative and yet to land in true substance. But nevertheless, it's one that we believe in and one that we're championing. And I'm gonna guess that by virtue of the fact that everyone's in this room, there's a bit of an echo chamber. And so I'm going to say something a bit contentious, which is don't tokenize everything, right? And we shouldn't be. And I'll go into the weeds on that in a second, but I just wanted to throw that out there just to be a little bit contentious.
The first volley has been served.
That's right. Oh, anyway, thank you.
All right. Hey, good morning. My name is Jeremy Ng. I'm the founder and CEO of OpenEden. OpenEden is an end-to-end out-of-date tokenization platform, and we bring regulated tokenized products on chain. So we have two products. Now we've launched a tokenized money market fund about 2 years ago, and it was the first ever tokenized T-bill fund that has a Moody's rating. And quite recently, about 2 months ago, we launched our regulated stablecoin. It's called Open Dollar, USDO. So it's also the world's first regulated stablecoin that is fully backed by tokenized treasuries, and with yield bearing as well. So very happy to be here, and yeah, I think there's a lot of things that we can talk about, including what you just shared.
Yeah, let's just jump right into that. I mean, we're looking at the real TVL, real volumes going up, mostly around treasuries and even some real estate. We saw Daniel mentioned a lot about the need to tokenize assets. Real estate seems really familiar for a lot of people. It's a store of wealth. It's similar, like it's really familiar to a lot of people. But treasuries have been just taking off just through the roof. Those are two very easy ones to do. What are the ones that are not so easy and we shouldn't be doing? Maybe I'll start right there, Nikhil, right back at you.
Okay, so I think the thing with real estate is that people get it, right? It's an illiquid asset. Right, whether you're an individual who owns your own home or you're in the institutional space, but there's a thing that exists already. It's called REITs, right? And so, do you need to tokenize real estate right now? Does tokenizing automatically create demand that wasn't there before? No, it doesn't. My point here is that there are a number of assets that would benefit from tokenization for sure, right? And actually, personally, I believe that crypto will be the financial rails going forward. But this is part of a sales pitch, right? The crypto space generally suffers from trying to win the argument and losing the sale, right? That old adage. And so there is a demand that doesn't exist yet. And so tokenizing real estate is a thing that will happen at some point in the future. 5 to 10 years is my rough guess, right? But I don't think the real problem with, or the challenge here is solving for demand and access and distribution, right? DAD, they're the 3 letters I use. You can tokenize whatever you want. Does that automatically create demand? No. Do institutions, do retail suddenly have access? No, they don't, right? Setting up a wallet, things like this, which are not the most straightforward of things, to be honest, right? For the layman on the street, it's not straightforward. And then distribution. How do you get that distributed? With things like real estate, there's a whole bunch of legal noise that exists, right? So I would actually say there's a lot of talk about real estate. Can you actually do it on Monday morning? No, I don't think you can, right? Are there other assets that could be tokenized and would benefit from it? Absolutely. IP is a great one, I think. But again, demand, access, distribution is a challenge that needs to be overcome. There's a whole bunch of hurdles that needs to be overcome, be it regulatory, legal, cultural, mindset, right? These are things that need to be overcome before we get them. So treasuries, I think, and actually these two are much better placed than me to talk about it, but it's intuitive. People need it for being on crypto rails, for collateral, for making things. It's the oil that allows for transactions to happen, right? So that's much more intuitive. But I would counter what you said there, Kenny, which is that real estate is, for me, it's not here yet.
Oh, really? Oh, okay. Well, maybe let's talk about something a little bit more esoteric or less familiar, carbon credits. I saw that in Daniel's earlier slide that it's expected to be a $50 billion AUM by 2030. That's not that far away, right? It's already 2025. So Alex, what do you think about carbon credits and that tokenization aspect? How familiar is it to a lot of people? And what's the drivers to get to that 50 billion?
Yeah, it's quite a niche market, that's for sure, and I come across lots of people who aren't familiar with it. But it's interesting, it's growing. I mean, historically, the carbon markets have been driven within the EU, within the US. There's this real drive around ESG, and we're starting to see that in Asia, as well as at Money 2020 last week. And ESG was a big part of the conversation. So these are becoming global markets. They're going to scale. The market's choppy. It goes up and it goes down. It's a commodity market, a small commodity market at the moment. But yeah, I think it's a really exciting time to be in carbon. But it has some big problems. The carbon markets are primarily an OTC market. The way carbon credits are traded is through sales desks. The liquidity is on the balance sheet of various broker traders who sit in the middle of the market. So it is an inefficient market to operate within. My first startup in 2019 was trying to make the most of this OTC market. We were going out, we were calling up project developers. We were trying to source some of their credits at a real low cost and distribute them into the market with a 50%, 100% markup sometimes. But when that happens at scale, and when that's the business model, this kind of asymmetric market, the money's taken out of the middle, and it doesn't actually go to where it's meant to go. It's meant to go downstream to the project developers, or upstream to the project developers, and downstream to the organizations who want to actually invest in the carbon. It shouldn't really be going to the brokers. So I think presenting the carbon markets as this kind of opaque OTC dominated market, and then knowing what the blockchain represents and what it can do in terms of the transparency of asset pricing, the ability to efficiently distribute it, you can kind of see that compare and contrast with old ways of working and new ways of working. So I think we've got a really cool case study in terms of demonstrating what carbon credit tokenization can do here in Thailand. We've worked with a company called SecondSwap, who some of you may be familiar with, and they're synced up to our tokenized marketplace for carbon credits, and they can distribute carbon credits to their customers through their True Money app at a rate that I guess has never been seen before in the carbon markets. They can send hundreds or thousands of transactions per day for micro transactions. That's sub 1 ton retirements of carbon credits. So we're servicing a very high velocity business model, which I think is really exciting. And the kind of cherry on the top is that with a SecondSwap, they're actually tokenizing carbon credits from Thailand through our infrastructure. So we've got a complete closed loop demonstrating a tokenized value chain for the carbon markets here. So yeah, I think a lot of growth potential in the market. It's a very inefficient market. But I think that's why blockchain and crypto to some extent has a real edge and can be quite disruptive within the space.
Alex, I heard a few things that perked up my ear. Inefficiency, information asymmetry, and if I was a trader, I'll be really, really interested. If I was in the audience, I'll be really interested to hear how can I take advantage of this opportunity today, because it's going to be a $50 billion market and in 5 years. So you mentioned a Thai company that's doing tokenization, but how can I, as a retail person or someone in the audience, how can I participate in carbon credits today, buy something, and hopefully it'll be worth a lot more in 5 years?
It's an interesting question. The carbon markets and carbon credits, I suppose, they're a commodity. They're meant to have a utility. You're meant to consume them as a corporate looking to achieve net zero, carbon neutrality.
Notice I said retail.
Yeah. So CarbonMark really serves that corporate, the corporate demand, let's say. Obviously, Klima, which is the founding project of CarbonMark, is really interested in the kind of more DeFi aspect of carbon markets. And so, there is an opportunity to play on chain with carbon credits. Klima itself has, as I said, tokenized 25 million carbon credits, developed strong liquidity on Polygon and Base. Where you can come and access today. And I think something exciting is that Klima initially launched with a model to utilize DEXs to build liquidity and facilitate trading and speculation within those DEXs. We learned a lot that this can bring a lot of volatility into the market, which maybe is good and maybe it's fun, but also it kind of doesn't resonate with the types of buyers who want to come into the carbon markets because they want something more stable and that's going to have a bit more linear growth. So Klima is going to be redeploying its technology over the next few months on the Base blockchain, internalizing a lot of the learnings from the past 3 or 4 years, or 4 years now. We launched in 2021. So if you're interested in the more DeFi element of carbon markets and what that can kind of showcase in terms of innovation, I recommend checking out Klima and following our launch as we gear up over the summer.
Great. So it sounds like there's access for corporates and there's access for retail if they go through Klima, through a DEX. And I think that's sort of a common theme that we're seeing, a big divide between decentralized users and centralized users. Maybe I'll pass it over to Rania next, because you're dealing in a very highly regulated space where a lot of restrictions, a lot of people can't touch it, but you try to grow your business. You're trying to look at what's coming up next. So maybe, Rania, we could share a little bit about what's coming up next and what you're seeing aside from your treasury business.
Yeah, thank you, Kanny. The short answer is public equities. U.S. public equities is what we're focusing on next. Just to take a step back on how we approach and think about this RWA category as a whole. U.S. dollars via stable coins is the first one to actually achieve product market fit, has about 200 billion in circulating supply today. And we at Ondo, were the first to actually come up with this tokenized treasury bills because we see these as essentially cash equivalent assets. We saw that users and holders of stablecoins actually have a need for this native yield that they call for themselves. And, as Kanny said, this market has now quadrupled actually earlier this year to just surpass 6 billion in TVL. And we've seen a lot of large institutional players, BlackRock, Franklin Templeton, Fidelity, UBS, etc., all entering the space, which they're many of them are partners of Ondo. And then looking forward, we actually believe that U.S. public equities will be the next wave of RWAs, precisely because these are highly liquid assets that we see in the real world that have actually real demand. And why are we bringing them on chain? So I think to kind of, echo what Alex have said, there are a lot of problems that we see in the real world, things like efficiency, information asymmetry, but also above all, I think the real problem we're trying to crack is accessibility. And a lot of it is, retailers who currently want to, but don't have means of accessing these high quality financial assets. And at Ondo, that's, one of the key problems that we're trying to solve. We've announced Ondo Global Markets 2 months ago. Essentially, we're bringing the top 1,000 US stocks as well as some index funds on chain. This would be fully permissionless. There would be cross-chain, and kind of day one, we're really just aiming to get distribution out there, and then subsequently more of these DeFi use cases like borrowing and lending that we actually don't even see in the real world.
Yeah, that sounds like a lot to come. I mean, I think just in the first instance, I'm hearing that I can actually buy tokenized Tesla stock, tokenized Apple stock.
That's right.
I could even short certain stocks. Would that be possible? Can I take a bidirectional view of the markets using Ondo Global Markets?
So on day one, it's really just about accessibility and distribution. So we're working with a number of key launch partners to just ensure, anyone here on the panel or in the audience can just very seamlessly and easily buy these tokenized stocks like Tesla and Apple. We will be looking to explore more of these use cases in day two. What else can we do with them, borrow and lend against these assets? But for day one, we just want to ensure there is a mass distribution.
Yeah. I want to key on this point, accessibility. I think that's a very common theme about real-world assets. It's like, it sounds great. I'd love to get some tokenized Tesla stock. I'd like to get some carbon credits and get into Cleveland today so I can trade up. But how accessible is it for everyone? Maybe I'll pass this over to Jeremy, because Jeremy, you're based out of Asia, and you have a different distribution curve, perhaps, than Ondo. What are you seeing in the markets, and how are you seeing the uptake for your business?
Yeah, I think distribution is always key and is always the most difficult thing to crack. But I think just kind of take a step back, right? There are a lot of projects that bring different kind of assets on chain, and whether it's from real estate, some people actually do that, to treasuries, bonds and equities. I think what we tend to not spend too much time on is on the risk side of things. And when I say risk, it is really a function of two different layers. So for example, there are a lot of stable coins out there, and they're generating different kind of yields. Some are using real world asset, whether it's the treasuries, some are using private credit, and some even go into more interesting crypto strategies like delta neutral basis funding trade. Now, I think all these are good, right? We're all trying to bring good products, yields, and accessibility to the market. But the very fundamental question is, where exactly is the risk? Is there any counterparty risk? Is there any issuer risk that any investors or holders are taking on? And I think that's really where Open Eden spends a lot of time in constructing and creating the product, because we believe that not all tokenized products are equal or built the same. Good example, if you look at during the global financial crisis, right? Lehman Brothers, one of the biggest investment bank. I remember I was on the trading floor when that news broke out, and immediately we see all the Lehman bonds and credits start trading down to say about 20 cents to the dollar. Any structured notes that's issued by Lehman Brothers, all follow the same downtrend, regardless of what the underlying asset they're wrapping, whether it's equities or bonds, could actually maybe only drop by 10, 15%, but because Lehman, as an issuer, they are insolvent. And then you compare against another product that Lehman, as the issuer, created using an SPV, that's bankruptcy remote. Now, that product actually, didn't trade down because it is ring-fenced, so all the assets, is still attributed to the asset value of the underlying. Now, kind of coming back to the crypto space, if a tokenized product issuer is either unregulated or not structured in a way that is bankruptcy remote, then essentially, you as a token holder, you're not only taking the risk of the underlying asset that's being wrapped or being tokenized, you are actually also taking the risk of the token issuer. And I think that is something that is actually super important as we move forward to try to bring more accessibility. And then you're talking about retail, which typically doesn't have as much information, right? They're not lawyers. And actually, neither one of us are lawyers here. So it's very hard to understand whether this product is as advertised as what it is. But in the real world, it's different because all the financial institutions that are selling financial products, they are regulated and they're licensed. And we all know how difficult it is to get a license, to maintain a license, and all the different kind of regulatory compliance and reporting that you're subject to. But these are all good things because it is to protect investors. So I think I'm just a little bit wary as we move forward, from the crypto space. We tend to really want to move fast, but we should never compromise on the investor protection side of things. So a long way to kind of answer your question is that, yes, we can give accessibility, but we need to do it in a way that is properly regulated and licensed. And it is still a challenge because globally, there's no one set of regulation that allows or disallows certain things. So we kind of have to be a little bit more pragmatic to kind of find the right jurisdiction or regulators that permit certain kind of product or distribution and just kind of go step by step and work very closely with the regulators.
Can I just add on also to Jeremy's point on risk? I think one reason why we're incredibly bullish about RWA is that it combines the benefits we see in traditional finance, like the legal protection, as well as the DeFi use cases that we can do in crypto. And just the way on how, Ondo's tokenized treasuries, i.e. yield-bearing stablecoin products are actually structured. It's the bankruptcy remote structure that Jeremy has pointed out. What that essentially means is that holders of our tokens always have a right to the underlying that is always fully backed, over-collateralized, and audited. But at the same time, this actual asset and token on the public blockchain is permissionless. So you can borrow and lend against these assets on secondary markets. You can use it as trading collateral, as payment, or just as native, treasury cash management solution. So the versatility of the product combined with these benefits we see in traditional finance is just really uniquely seen only in the RWA space, and I think is really why this asset class is positioned for success.
Nikhil, you want to jump in here?
Yeah, I just wanted to build on that. So I think that your accessibility point, I think, also comes back to demand. So I think I'm going to simplify it into and say there's two camps. There's retail and there's institutional. Tokenization doesn't inherently mean that there's greater demand. And I think tokenization is often talked about as having inherent superior liquidity, right? But that isn't the case. And so I think accessibility for retail is hard, just because operationally you need to get the layman on the street to download a wallet, right? Save their phrases somewhere. All of that stuff is hard, right, for the layman. So can retail access custody, for example? No, they can't, because most custodians say you've got to be an accredited investor or some equivalent definition. On the institutional side, I think it's easier, but then it comes back to regulation, to your point, Jeremy, right? Which is there is an unlevel playing field where regulators, I think, to be honest, are asleep at the wheel a little bit, where they don't really know what the risks are that they should be protecting against, right? You've got some regulators who are further up the curve. You've got other regulators who are, well, as I say, asleep at the wheel or not even wanting to engage. And so that makes it hard to solve for accessibility and then at the same time just solving for demand, both in operational terms, i.e. the headache, I'm going to call it, of having a wallet, right? And everything that comes with it, through to the headache of having to use custody. But custody is key. Right, if institutions are going to get involved, because no institution right now, correct me if I'm wrong, but no institution is willing to self-custody right now, right? Very few. Self-custody, yeah, right. So I'm saying the accessibility point comes back to demand.
I looked at I've actually seen both structures of both Ondo and Open Eden. They've set it up with a bunch of lawyers, the best way possible given the regulatory climate today. This is These are professionals doing the best job they can given this current climate. And they've built a business on top of that. Even the best structure today isn't the most optimal structure today. Nikhil, you mentioned the need for self-custody, or is the token issuer custodizing for yourself. Most retail will come in and say, well, it's going to be self-custody. They're going to be taking the tokens and they're going to be putting in the wallet somewhere, and they want to earn the yield because it's tangible. That's why people are in Web3. I posed a question to a custodian earlier about what is the strategy to touch retail, to well, we can start doing that, we can start offering stable coins. I'm like, what if I wanted to customize my meme coins, my Doge? It's like, oh no, we don't touch that. I was like, why not? It's top 12 token. Why can't you touch this? Well, it's just not part of our regulations. Our regulators don't recognize meme coin part of our token listing process. I'm like, oh, okay. So then as a corporate or as an institution, you become the arbiter of what retail wants and what they need, and you define what the accessibility is. And that's also another way to limit the distribution. And Jeremy, I want to come back to you because I'm hearing that the demand for your product is off the roof, and there's some limiters that are stopping you from actually even distributing even more. It might be regulation, it might be compliance or whatnot, but what would you need to unlock for you to hit that 1 billion TVL, the 2 billion TVL?
Yeah, well, first of all, I would say that it's not exactly limiters, but it is a growth in a risk-managed manner. So there's a big difference, right? Whether you are a licensed and regulated entity like Open Eden, versus maybe another token issuer that is not regulated per se. So being licensed and regulated means that you need to operate in a certain framework. And as you grow, especially in our space, which is really at the frontier, and regulators, I wouldn't say they're asleep, but they are trying to catch up. They're trying to catch up and trying to learn. So we need to work with them and educate them and get them comfortable. And in order to get them comfortable, you can't just grow wildly, right? And it's not like a wild, wild west. You kind of do it in measured pace. Whether is it in terms of who you can distribute to, what kind of products in terms of the risk curve, or what kind of notional size. And I think that over time, once you get the comfort and the confidence of the regulators, then really there is no real limiter. In fact, it is a tailwind, because if your product is in the market, fully backed by, being licensed or being regulated, by A, B, and C. So for example, we at Open Eden, we have a digital business asset license out of Bermuda as a token issuer. It's the same regulatory body as a lot of our big boys like Coinbase, Kraken, Circle, and whatnot. Then it actually instills a lot more legitimacy and credibility than another similar product per se that doesn't have that regulatory compliance branding. So I would say that for us to get to a billion is not too far away. We're already over 200 million of TVL, and our product was only launched, say 2 months ago. But I would say that we're in it for the long term and for the long game. And we have seen so many examples of people thinking about too big to fail. That is the last thing that we should have that mantra. We've seen that in Lehman Brothers, and even in our, we've seen so many of them, right? FTX, Genesis, Luna, and all these guys are the biggest player, and they all can fail if there's no proper risk management or if there's no proper regulatory oversight.
I think, Kanny, you mentioned this interesting thing about, regulatory landscape isn't exactly very clearly defined, but we've seen that post the, new U.S. administration, they're looking into launching a stablecoin framework. The way how Ondo Finance is structured is under exemption in the U.S. SEC, Reg D, Reg S, that definitely gives us certain limitations, such as in the primary market. As a U.S. company, we actually cannot sell to U.S. customers, for instance. But, as this landscape landscape is evolving. We're seeing a lot more maturity in the space. Ondo is one of a few players, and if I may say, probably the only RWA player to be very closely aligned with the current administration in helping them to actually define what this landscape looks like. Actually, just yesterday, our CEO as well as Chief Legal Officer was in Washington, D.C. and just had a meeting with the US SEC. We want to work very closely with them as we start providing more clarity in the space.
Yeah, a few comments. I think carbon markets, carbon credits are an interesting kind of juxtaposition with what you guys are describing there. They're in, the spot markets are unregulated, and so what you have seen is kind of, as you described, you have seen institutions, particularly the gatekeepers, the carbon standards, take positions on tokenization and blockchain. And basically decide unilaterally who can and can't access the market. In some respects, that's annoying for us because the largest carbon standards are the least receptive to blockchain. Perhaps it's because they feel they have responsibility and they feel like blockchain poses a risk, or perhaps they see it as a threat to their business model. I don't know, and couldn't comment. But yeah, we do kind of have this strange situation in the carbon markets where the newcomer registries, the newcomer gatekeepers are pivoting their businesses or in fact immediately building their businesses on the blockchain. And you have this much more conservative group who have been around for 15, 20 years who don't want to accept the blockchain. And it just creates a really interesting dynamic. And I guess the way to unlock the kind of naysayers is, as the points kind of raised, articulate, is kind of being consistent, looking for incremental wins, and over time you'll get those unlocks, and then that's how we'll get more flows on chain, which is ultimately our objective.
Sorry, Nikhil, you wanted to add on to that?
Well, you're talking about, where's the next billion, right? So private credit, I think, is the next, is where the space which is untapped and which I think will come through. I think stable coins, treasuries has been both the practical, intuitive place to play because it's needed, right, to make it's the oil, as I call it, right, to allow things to happen. People are looking for incremental yield. People are looking for collateral. There is a tiering, though, right? And this, having crapped all over real estate at the beginning, I feel like I ought to sort of pull back a little bit. Right?
Don't take it back now. Come on. Let's keep going.
I'm not saying it's never going to happen. I'm just saying it's a sequencing, right? And I don't believe that real estate is there just yet. But there is a tiering where things like treasuries are at the top of that, because they're just so liquid, right? And it's needed within crypto space for the rails, for the infrastructure to operate and manifest itself. Then you go down that stack, and private credit is a space that today is just bilateral, really, right? There is no multilateral marketplace for it, should we call it? And so that lends itself to all of these things that tokenization purports to be. And so we at EMURGO are seeing a lot of demand in that space in the Middle East, across Southeast Asia, partly because of the inherent way those markets work, be it Sharia law or otherwise, right? Which means that there's a lot of juice, right? A lot of value to be unlocked through tokenization. Now, we will keep going, we collectively, the world, will keep going down that stack as people become more familiar, operationally able to solve for those three pain points: the demand, the access, and the distribution, and ultimately you will get to real estate, right? Or the most illiquid assets, right? Which will benefit from tokenization. But where's the next billion? It's private credit, in my view.
Yeah, so that's actually a really, really interesting point. Private credit, you typically get higher yields. Like there's higher risk, there's high yields, a lot more opaque as to where things are, whether it's bankruptcy remote or whether it's sitting at a custodian who's actually holding the underlying, and how is the income being generated? Is there an auditor behind it who's watching and making sure that the income's kind of flowing in? But you typically get compensated for that risk. So if I'm a customer, I'm here to earn some yield, you would typically take maybe like a portfolio view. I'll do some on a short-term basis, I'll do some below 10% and some above 10% to create a laddered portfolio, like a sane investor. But Nikhil, what would you guide us to in terms of this private credit market where I want to earn 20% but safe? 40%.
I want that too.
Yeah, everybody in the audience.
High risk, high return, right? Every
101%.
wants that.
Yeah, low risk, high return. Can you share about how we can get there?
So look, I think there are products that work perfectly well in traditional space. There's no need for blockchain to be anywhere near them, right? However, if you tokenize them, you're now putting them in a format that makes them more intuitive and accessible to areas, let's just call it crypto space, right? Where there is a lot of capital there, right? And it makes it easier, it makes it more intuitive. The sales lead time and the sales pitch is reduced, right? Because you've now got it in a format that they understand. And so there's capital that's looking for risk, right? And so that is the starting point with all of this, right? That's our hypothesis. We will go to the crypto natives because they're the ones with the capital and they get it, in inverted commas. Selling some of this to the more traditional space, again, just boils down to sales lead time and the sales pitch. Where are they on the education curve, right? So from that point of view, the selling the concept of tokenization, selling an actual tokenized asset is just part of a sales lead time. And are you willing to, educate, essentially? With regards to assets, I mean, clearly I've given my position on this, right? Which is start at the more liquid end and then work your way down, right? If you start off with the most liquid side, I think, to be honest, I just think it's a hard sell, right?
And also there's a lot of risk, right? So I agree that, let's go with things that are a lot more liquid and a lot more easier to understand. So equities, I think, I do agree with Rania on that. Because if you look at private credit, yes, it is very attractive from the perspective that the yields are higher. But what we have seen is there are a couple of private credit products that actually was being offered on the blockchain, either through DeFi or CeFi, that actually has been quite disastrous. And there's one particular stable coin that is fully backed by private credits, and recently it unpacked or depacked, because of bad debts and whatnot. And then, like 2 years ago, there was another DeFi firm that has over $1 billion of TVL that was offering a lot of private credit. And unfortunately, some of these underlying credit quality just deteriorated. So the danger is also, again, when it comes to tokenized products, and especially if it is offered to the mass market, I think the educational part is very important, because if not, then people typically will just chase after you, and they're getting into products without understanding the underlying risk, and then they end up losing money, and obviously, giving a bad name for some of these tokenized products. So yeah, I think, bottom line is, let's start out with things that people understand, they're liquid, and then we move from there.
Part of this is nomenclature. I mean, if you're tokenizing private credit, and I don't know, I mean, private credit is a huge umbrella term anyway. It could be distressed debt, for example, and calling it a stable coin.
Hidden stuff.
That's a problem in of itself, right? Yeah. And unfortunately, retail are just going to say, oh, it's a stable coin. It must mean it's stable, right? That's just a tokenized
calling it a stable coin. That's the problem, right?
That's the problem. Yeah. It's a problem.
It's a high-yielding stable coin. So I think that's inherently what people are looking for. Maybe I'll just put on the hat of retail and say, I do want something that's high-yielding. Like when I was going through all the different opportunities that are out there, you typically sort from top to bottom. It's like, what's the highest? And I'll start going downwards. You don't go bottom up, right? It's the same thing when you buy something. You go lowest to highest.
Well, this is okay. So this is education. I think it's also the arbitrary threshold that's set by many regulators of something like accredited investor, right? So in Singapore, it's $3 million in assets, or what is it?
$1 million or 200,000 or 300,000.
Thank you. Okay, yeah. $1 million in assets or more than 200 Sing in income. I know plenty of people who satisfy that threshold. They're a bunch of idiots, right? It's arbitrary, right? So how do you educate people? And so the regulators, and I can say this because I'm not regulated like you are, right?
Boy.
So I'll say it.
Yeah.
The regulators sleep at the wheel, and there is an unlevel playing field, which is going to be beneficial for some, right?
Yep.
And clearly not beneficial for others. But the holistic need to educate retail, because that's what you're talking about, right?
Right, yeah.
As well as institutions for that matter, right? But I'm just saying that something like accredited investor is arbitrary, it's meaningless.
Yeah, I mean, everyone says that with crypto, education is the big key. You know, sharing your voice, educating them to make an educated buy. But at the end of the day, most regulators don't want you advertising, really. You know, if you see how the U.S. has viewed crypto ads, how actually, if you ever tried to put a crypto ad on Google, if you tried to put a crypto ad on a billboard, that ship has long sailed. You know, good luck trying to get it up there now. So if you're looking to educate, you're kind of hamstrung. If you're looking to scale, you're beholden to which regulatory regime that's most progressive today. And everyone here probably on the stage is looking to build a global business that doesn't have this framework today. So maybe I'll just end off with asking each of you one question: is that where would you place your big bets to unlock the next 10 billion? Let's forget 1B and 2B. I believe both OpenEden and Rania will surpass that in the next 6 months. So let's get up to 10B. Where's your big bet?
Yeah, happy to start. Yeah, you know, Ondo, we've already crossed 1B in the tokenized treasury space. This market overall has quadrupled to 6B already at the start of this year. So honestly, at this trajectory, possibly by year end next year, who knows, might already hit this 10B category.
Write that down, guys.
Of course, you know, we're incredibly bullish, as I said, about public equities. Jeremy said highly liquid, you know, financial instruments. But, you know, earlier you also touched on the point of education, as everyone, you know, has. So I think just to also, you know, wrap up, I think we really think 2025 is the year of tokenization. You know, Tinan said that this is the year that we're really building. No one's really even questioning the why anymore. I think the benefits, we already talked about that extensively in the last hour. But we see a lot more players actually coming to the space, not just, you know, retailers wanting access to high quality financial assets, but also, you know, institutions coming in, right? A lot of these big players as well, not just we see in the US, even out in the APAC region as well. You know, China Pacific Insurance working with Hashkey. Here in Thailand, we've got TokenX, tokenizing real estate, you know, all sorts of different like other asset classes. But really, you know, in short, I think, you know, stable coins was the first to do for the US dollar, the first RWA to hit product market fit. And we're, really excited for Ondo to do the same for capital markets. And we'll leave the expertise of other asset classes to the other players.
Sure, yeah. Well, over to you, Alex. You're going to hit 50B in 5 years. So 10B next year should not be a problem. Rania has already set the watermark here.
Yeah. So you asked me where I place my bets, and I'm very exposed to carbon, so I will place my bets on carbon. Look, I think it's going to be an exciting few years. NASDAQ are the major shareholder in Puro Earth, which is an upstart carbon registry which focuses on carbon dioxide removals. CDR is, it's got a lot of good sentiment around it right now. It's kind of got the integrity, it's got the impact, it's investable. And NASDAQ recently announced that they're going to transition the Puro registry onto the blockchain. So it's happening. I think there's the kind of old stalwarts in the market. It'll take time to turn them. I think they will get turned. I think blockchain has a right to win in this OTC-dominated commodity market. So 2030, I think that we'll start to see serious scale through the blockchain. The next couple of years, it's going to be incremental wins and just kind of hang in there.
We're going to see a hockey puck in 2029. All right.
Heard it here first, yeah.
Heard it first. How about you, Nikhil? What's your big bet over the next year?
So it's going to be private credit. Right, but I think it's a big umbrella term. So I think within that, it's starting for the more liquid end, because it's already liquid. Tokenizing is not going to bring anything more there. And then moving down that stack, if I'm going to go out on a longer time horizon, then I'm going to say IP. I am going to say real estate. Right, yeah, and I'm a real
full circle back to real estate.
I know, yeah.
Amazing.
Well, look, I mean, I think something like, Australia has a big reverse mortgages market, right? Japan is very intuitive to me, right? You've got an aging population. Why would they not tokenize their real estate and sell it to a younger population who wants to get onto the property ladder in a format that the younger generation can understand, right? At least in my head, it's very simple, right?
Yeah.
So I do think IP, real estate, and I think the third one is data and information. Tokenization of data, infrastructure, information.
Quite a wide area, yeah. I'm just going to leave you with my tip. High-yielding stablecoin. Trademark that, okay? Last but not least, Jeremy, what's your big bet over the next year to hit that $10 billion watermark?
Yeah, so for me, it would be credit, but more on the public credit first, before private credit. Basically, you have seen how U.S. Treasury's tokenized product has taken off. It means that people are hungry for yield. And now I think it makes a lot of sense to kind of move up the risk curve on the credit side of things so that it is still relatively less volatile than, say, equities. But at the same time, it kind of gives you the income generation. So I would look at investment grade, high yield, emerging market debt, and especially looking at the interest rate environment right now. We probably have seen the high of interest rate. And heading into next year, interest rate is probably going to go down. So taking some duration risk is probably a good idea. And hopefully the economy recovers, then credit spread should also tighten. So if you go into some of these public credit, it's liquid, you can generate income, and you can also potentially generate capital gains. I think that would be quite interesting.
All right. Looks like we're just about out of time here. So I want you to give a warm thanks to all the panelists today. We're going to be hitting 10 billion by next year, so we'll come back on stage here, all right? Thank you very much.
Thank you.